Hi, and welcome to this session. Today we're going to take a look at asset allocation. It is a big topic, so I've split it into two videos. The first part, we're going to have an introduction and look at some of the objectives of asset allocation. In the second one, we're going to look at some more of the quantitative methods using optimizers and alternative approaches. In the first session, we're going to make sure that we understand the purpose, the function of strategic asset allocation within the overall framework of portfolio management. We'll also discuss how strategic asset allocation works and how it accommodates the systemic risk, the risk that comes from the broader economic environment. We'll also compare and contrast the use of strategic versus tactical asset portfolios, and we'll appraise the importance of asset allocation within the overall framework. Now, I think many people have seen the way that asset allocation works in general. This is an example from Morningstar of a mutual fund that's actually called Fidelity Global Balanced. Now, this is information that Morningstar posts that tells potential mutual fund buyers, if they buy into this portfolio, what do they expect to get? The name is going to be at least part of the giveaway. It's global. In other words, it's going to be an international portfolio, probably based on world indexes for bonds as well as for equities. It's also a balanced portfolio, which means that it also contains things like bonds as well as equities and perhaps some alternative investments. And in fact, as I read through this report, you can see that they do provide us with a bit of a breakdown. Now, they start off by telling us that the portfolio is made up of US and non-US stock. Predominantly US stock, because that is where the world's largest markets are. And also many of the international firms are going to be listed on US stock exchanges. But it has a substantial exposure to non-US stocks. And it has a substantial exposure to bonds. I'm not sure what others are, but a very small amount. And there is a cash cushion that's in there. That's their current asset allocation. We can only assume that is close to their strategic asset allocation. But if we compare that to what Fidelity expects in this kind of a portfolio, you can see, here we are, the same numbers that we saw before: cash, US stock, non-US stock, bonds, and others. The numbers that we've actually got are there. And the fact that they're all long is not a big surprise. That's a typical position for a mutual fund. They're not holding short positions. In fact, they may be constrained to only hold long positions. You'll see there's a column called benchmark. That's what Morningstar expects out of a global balanced portfolio, whether it's Fidelity's or anyone else. And we can see that the category, which includes a number of other mutual funds, has also got these kind of investments. But here we see something interesting. This firm has less in cash, or this fund has less in cash. It has got more in US stock, it's got a little bit less in bonds, and other funds have got more investments in other category, probably alternative investments. What does this mean? Well, it means this fund manager has decided to go particularly heavy into US stock, go particularly heavy into bonds, and not so much into cash, and not so much into others. When a particular fund and fund manager has decided to go into a category a little bit heavier, we call that being overweight. So we'd say that they're overweight in terms of US stock and underweight in terms of cash, compared to the benchmark, compared perhaps to the rest of the category. So that says something to us about their overall strategy. You can also see, as you look further down in the report, that they give us some more information. A little bit hard to read all of this detail on a slide like this, but you can see they give us a breakdown of the different countries in which they've invested. Remember, this is a global fund, so they're invested in Japan, Germany, United Kingdom, Italy, Netherlands, France, Canada, and so on. And so the weighting that they've actually achieved is shown by the solid bar. And so for Japan, for example, it looks like they've invested about 25% of their bond fund, and here we're just looking at bonds, compared to a benchmark of 14%. That means that they're significantly overweight on Japan. They are significantly above the category average. So if you believe that Japan was going to outperform, this particular fund would be attractive to you. You can see they're underweight on the United States. They're a little bit overweight also on Germany and the UK. Overweight on Italy. Right at weight on Canada compared to the benchmark, and in most cases compared to the category average. You can also see, talking about the bonds, and it is a little bit hard to see all of that information, they there is information about bond duration, whether or not their bonds are going to be long-term or short-term. That contains a lot of interest rate information about interest rate risk, the duration of the bonds, compared to the average for the industry. So here we can see that our fund is significantly overweight on 7 to 10 years. Longer term investments produce higher yield but have higher interest rate risk. So being overweight in certain categories implies extra risk. Now, that's just a quick introduction to how the asset allocation might look on a fund. What actually drives this? Well, we know that strategic asset allocation is the long-term view. Strategic or strategios comes from the Greek, the term for the generals. So these are decisions made by the generals. Our strategic asset allocation essentially combines the investor's objectives and especially those risk constraints and puts that together with information about the market, the expected returns from different classes of assets in the market, and puts those into a portfolio that's going to meet the IPS, the investment policy statement objectives. Our purpose, of course, is not only to meet the investors' objectives and constraints, but to make sure that we are complying with their expressed interests. The process provides us with a set of our portfolio weights, and that becomes the policy portfolio. Now, we deviate from policy all the time. We might be a little bit overweight or a little bit underweight. Perhaps we've decided this is a really risky time and we've gone mostly to cash. So in the short term, we may deviate from policy, but we have to know what the policy was first. So setting policy is the purpose of the strategic asset allocation. Now, when we talk about systematic risk, well, systematic risk is the risk that comes from the broader environment. We're always going to be exposed to this kind of objective risk, the risk that affects everyone. Strategic asset allocation aligns our portfolio risk profile with the investor's objectives, but also it provides a relative level of higher reward for accepting some of the risks that are going to come from that environment, the non-diversifiable type of risk. Particular classes of assets, bonds, equities, alternative investments, cash, and so on, have all got their own distinct risk exposures. Some have more exposure to market risk, some have more exposure to interest rate risk, country risk, and so on. So the asset allocation effectively tries to limit the overall effect of the systematic risk within our portfolio. Our strategic asset allocation also provides our investors with some easily expressed benchmarks that we can communicate and says this is the mix that we intend and this is the risk and return in an idealized case. Now, the difference between strategic and tactical, well, we know that from my earlier comments that strategios is of the generals. Well, what about tactical? There's no place in Greek history that tells us about this, but I would assume that tactics belong to the sergeants. There are short-term or shorter-term, more responsive reactions to changes, especially short-term changes in the environment. Going to cash, for example, is a tactical move. We might decide that the risk level is too high, the volatility is too high. Now is a good time to take part of the portfolio and set that aside in cash to reduce our overall risk. Maybe we're going to take our bond exposure and move from BBB bonds into AAA bonds, just to be safer. Those strategic actions can actually be captured within a particular portfolio we'll call our tactical portfolio. And we describe the behavior of our tactical portfolio as tactical asset allocation. And those are short-term adjustments to asset weights based on predictions of things that are going to happen in the short term. Where we think of the strategic approach as being passive, tactical is much more of an active approach. When we're looking at the history of academic study of portfolio managers, we see there are several threads or particular areas that academics have looked at. Many studies have indicated that aside from the returns that come from the market, the vast majority of portfolio returns can be explained by the asset allocation choices, not so much security selection, picking winners and losers, or the timing of moving money from one to the other. Some studies that exclude the time series elements, that particularly look at factors of that success, suggested that asset allocation is actually producing less of the contribution, although still a significant amount, and that security selection might be more important. And even other studies have shown that the distribution, the variance of the results between the average and the best and the worst, show that there is some benefit from having managers who are better than average at choosing security selection, although the ability to replicate the individual portfolio manager's behavior is actually quite limited. Another concern, and something that we've mentioned earlier in the course, is asset liability management. Now, if you are running something like a pension fund and you know what your liabilities are, you have to pay those pension checks every month. That gives you an idea of the timing and of the stability of the demand on your liabilities. Of course, an asset liability approach would say that we have to have assets that are going to be matched in terms of the demand and the stability. So asset liability management specifically predict future liabilities and adopt an asset allocation structure that's going to work with that. The alternative to this is to forget about liabilities and just say we're going to go for the highest possible return, and we're not going to be concerned about specific liquidity and stability targets. So those are considered indirectly, but they're not going to be explicitly part of our portfolio process. Now, aside from looking at asset liability, we have approaches or ways of studying information that is either dynamic or static. Asset allocation, returns and liabilities in one period may help to predict the changes or the returns in the next period. So looking at the changes over time becomes part of our process. A static approach basically says these are the long-term average returns, and we're going to use the static model, and we're not going to change our model when new information is introduced. We're also very concerned about the overall risk and return. Our return objective essentially says that we can quantify the returns based on specific goals. We need to provide a 5% payout ratio plus inflation. That might be our quantitative return. Qualitative returns essentially say that, well, we expect that we're going to do a certain amount better perhaps than the others. Of course, with compounding, we're going to be looking at the returns using a geometric return and using the multiplicative rather than the additive formulations. In other words, 5% times per year times 5 years is a lot less than a 5% return every year to the x power. Our risk objective can be assessed qualitatively and quantitatively, below average risk or above average risk. And for quantitative, we look at information like acceptable levels of volatility and standard deviation. We try to differentiate between general risk and the risk that something's going to get worse. And there's something that's called Roy's safety first criterion that we'll talk about a little bit later in the course. Some of our criteria for specifying an asset class, well, a couple of important terms here. We assume that all of the types of investments within a particular asset class are essentially of the same nature. They're homogeneous. In other words, we can't break them down into two separate subcategories that make a lot of sense. They essentially have the same set of defining characteristics. We would also say that asset classes should not be capable of containing the same kind of assets. Now, here's where you see some interesting problems. If I want to invest in certain stocks, let's say Alibaba, traded on the New York Stock Exchange, is that an American stock or is that a Chinese stock? Clearly, there's a lot of exposure to Chinese market by investing in that company. So while it would be within my category of US equities, it would also be part of my world markets equities as well. There's a problem where it's not mutually exclusive. It can actually be in two camps at once. Asset classes should not have the same correlation. In other words, if we mix up our asset classes, we have a lower correlation coefficient when we combine the two, and so we're actually protected by diversification. All of the asset classes put together should be the sum, the universal sum of all of the possible investments. We seldom get there because we don't have funds that include everything. Not everything is tradable. Asset classes should also be able to absorb a significant proportion of our overall portfolio without us buying up the whole market, which would then create a liquidity crunch. So if there was a particular asset of which we could corner the market, buy all of the palladium in the world, and that would fill our categories requirement, it would also decrease the liquidity and make it hard for the market to work. So that's clearly not a problem for smaller portfolios. When do we include an asset class within our category? Assets should be added to the portfolio if they improve the overall, big term here, mean variance efficient frontier. And we're going to look at that in the next video. Essentially what this says is if we're plotting risk and return on a chart, that's going to be our mean variance space. And within that space, there's the optimal combination of risk and return. You always expect to get a higher rate of return for a higher level of risk. And that gives us a kind of a frontier or a barrier. We'll look at that one in a couple of minutes. We see that happens if the assets class Sharpe ratio, another important term, exceeds the product of the existing portfolio Sharpe ratio and the correlation between the asset class return and the portfolio risk and return. So here we say, first off, we'd say, what the heck is a Sharpe ratio? Well, it's something we've introduced, and essentially the Sharpe ratio is a risk-adjusted rate of return. You can see an example of the formula. Now, William Sharpe came up with this as a measure of discounting overall excess returns for higher levels of risk. So we have to have those two bits of information. In the numerator, it tells us that the expected alpha, now R sub A minus R sub B, is essentially alpha. The return to our portfolio minus the return to some kind of a benchmark, probably the risk-free rate. So if we made a 30% rate of return and we had a 5% risk-free rate, 30 minus 5 would give us 25. And if we expect that's going to be true in the next periods, because we're consistent, that would be our expected alpha. Now, standard deviation is an important number, because if we're comparing different portfolios, you say, well, he got a higher alpha than she did. However, he took much more risk in order to get that. So we want to discount that for higher levels of risk. So the portfolio standard deviation is that little sigma in the denominator. Now, diversification comes into this, as I mentioned in the previous slide, because an asset, for example, with a Sharpe ratio of 0.2, it's a good number because we have a positive alpha in order to see this. So we have a Sharpe ratio of 0.2, and our portfolio that exists has a Sharpe ratio of 0.15. There's also going to be a diversification factor, 0.9. It's highly correlated. 1 would be a perfect positive correlation. So it's less than perfect correlation at 0.9. We would add this extra portfolio, or this extra set of investments to our portfolio, because 0.2 is still greater than 0.5 even after accounting for the benefit of the of the correlation coefficient. So 0.15 times 90% would be 13.5, and 0.2 is still higher than 0.135. So quick introduction to a couple of ideas there. Correlation and Sharpe ratio, we're going to be talking about these a lot more in the rest of the course. Now, some of the particular types of assets that we're concerned with in our asset allocation How about international assets? We generally like to have an internationally diversified portfolio following, I don't know if you recall, Markowitz's view, or Harry Markowitz talking about the benefits of diversification and the reduction of the systematic risk. Well, when we're adding more and more country assets, we further decrease that systematic risk. So we're not just exposed to the American economy, but we're also exposed to the European economy, the British economy, the Chinese economy, and so on. When we're investing in international assets, some of the specific issues, though, we need to consider. What about currency? Whatever we gain from increased returns in those new markets may be eaten away with because of the strengthening domestic currency. And if we do have that kind of currency, is it something that we can hedge, something that we can use derivatives to cover? The reduction in systematic risk might also disappear when we end up in times of real disaster, because money moves quickly around the world. And so the benefit of diversification is largely decreasing. There's more correlation between markets. We wake up in the morning and we see that something's happened in the Japanese or the Chinese stock market. Our trades in the morning take that into account. So a fall in China would result quite often, especially in a time of panic, in a proportionate fall in the domestic markets. And so the benefits of diversification are largely lost. We also see that certain emerging markets are also a bit problematic. They may have more insider trading, there may be less trading activity, a smaller proportion of the shares that are available are actually traded. There's less transparency, and legal systems might not support contracting the way that they work in our own market. And we also see that many of the returns will be abnormal distribution, skewness, and kurtosis. Other terms we'll talk about a little bit later, possibly because of thin trading, but even more likely because of that insider information. Another class of assets that are often part of our strategy, inflation-protected instruments, like inflation-protected bonds and even convertible preference shares. There's typically a high correlation within the class of overall bonds and a low correlation with other assets. So this might actually be better for diversification than just going with bonds. This is particularly suitable if we're dealing with a highly risk-sensitive, interest rate risk-sensitive set of liabilities, as perhaps a bank or a pension fund, an index pension fund, might be dealing with. A third area that we're also going to be concerned with, alternative investments. Now, alternative investments includes things like private equity, commodities, hedge fund investments, just about everything that is not part of bonds and stocks. So if we're going to invest in these kind of assets, this might also give us an increased ability to diversify, but it requires special skills, and quite often specialized investments are dealt with through specialized fund managers who are better able to judge the quality of these informationally dense and opaque type of investments. Correlations between are typically very low, but also the data tends to have several problems. We'll come back to that when we look at Chapter 7 from the Begin textbook. When we're talking about asset allocation, and this is where we're pretty much going to finish this session, some of the steps. Well, first off, we have to know our investor. Know your client, a term that I've repeated several times during this course. It means we have to consider the investor's overall net worth and attitudes towards risk, and develop a particular model of risk. Determine the risk tolerance levels for that particular client and live within those. Capital market situation and our capital market appreciation, how well we understand what's happening in the different markets for equities and bonds and alternative investments, is going to be a big part of it. What do we expect is going to happen for the next 3 months, 6 months, year, for 5 years? We establish our prediction procedure. Of course, predictions are exactly what we say. Predictions, they're a guess made by an expert. So hopefully an educated guess. From this information, we can generate our expected returns, the predicted standard deviation, and by looking at historical patterns, we can observe the history of correlation and put all this together to develop our overall strategy. And that's where we start talking about mean variance spaces and black litterman and all of the different type of optimizers we'll be looking at in the next video. We use this to select an asset mix, and then the actual returns are going to provide feedback for the process. This is the easy part. In the next series, we're going to take a look at the approach that we use, the optimization approach, to finding the right mix of those assets. We'll look at several different approaches, from the simple type that we'd apply to an individual investor to the much more complex. Join me for the next video. I'll talk to you soon.